This is the Commodities Institute podcast. I'm your host, Emily Costa, and today is Thursday, April 16th, 2026. We're going to begin today in the oil market, where the geopolitical risk premium is no longer theoretical, it's embedded across the entire global energy system. At the center of it all is the Strait of Hormuz, a narrow waterway that handles roughly one-fifth of the world's oil and liquefied natural gas flows. Since the outbreak of conflict at the end of February, traffic through the strait has been severely disrupted, effectively choking one of the most critical arteries in global trade. Now we're seeing the first signs of a potential shift. Iran has floated a proposal that would allow ships to pass safely through the Omani side of the strait, provided broader negotiations with the United States result in a deal. On the surface, that sounds like de-escalation, but in reality, it highlights just how fragile the situation remains. The proposal is conditional, partial, and leaves open key questions, like whether all vessels would be granted safe passage and whether existing threats such as mines would be cleared. In the meantime, the disruption is very real. Hundreds of vessels and tens of thousands of seafarers remain stranded, and shipping activity is still far below normal levels. Even with a ceasefire in place, the market is pricing in the risk that this choke point could remain constrained for weeks, if not longer. And that brings us to the next layer of the story: refined products, and specifically jet fuel. Across Europe, alarm bells are ringing. The region is heavily dependent on imports for jet fuel, with roughly 3/4 of supply typically sourced from the Middle East. With flows disrupted, airlines are now warning of potential shortages within weeks. The International Energy Agency has already flagged the possibility of a supply crunch by early summer if replacement volumes cannot fully compensate for lost Middle Eastern supply. And that's a big if. Increased shipments from the United States and Africa are helping, but they're not enough to fully close the gap. What makes this situation more precarious is the structure of the system itself. Many airports operate with limited on-site storage, and supply chains are designed for efficiency, not resilience. In other words, there isn't a large buffer. European policymakers are now scrambling to respond. Plans are underway to maximize refinery output and better coordinate supply across the region. But refining capacity has been declining for years, and in many cases, facilities are already operating at or near maximum output. So even with intervention, there are physical constraints that can't be easily overcome. The risk here isn't just higher prices, it's the potential for flight disruptions, cancellations, and a direct impact on the summer travel season. Now, let's move into agriculture, where the ripple effects of this energy shock are becoming increasingly visible. In India, urea prices have surged to around $1,000 per metric ton in recent tenders, nearly double the levels seen just 2 months ago. This is a direct consequence of disrupted natural gas supply, which is a key input in fertilizer production. India is the world's largest importer of urea, and the scale of its buying matters. When India steps into the market at elevated prices, it effectively resets the global benchmark. Smaller importers, particularly in parts of Asia and Africa, are then forced to compete at these higher levels, which can have significant implications for food production and affordability. At the same time, we're seeing shifts in planting decisions in Europe. In France, maize acreage is expected to decline by between 10 and 15% this year, with some regions seeing even steeper drops. The reason is straightforward: higher input costs. Maize is an energy and fertilizer-intensive crop. As those costs rise, farmers are pivoting toward less resource-intensive alternatives, like sunflower, or leaving land fallow altogether. This is how energy shocks translate into agricultural supply changes, not instantly, but through gradual adjustments in behavior that can reshape production over time. Now let's turn to metals, where the impact of this geopolitical disruption is more nuanced, but no less important. In China, crude steel production fell by over 6% year-on-year in March, hitting its lowest level for that month since 2020. The primary driver here is margin compression. Input costs, including iron ore and energy, have risen, partly due to higher freight costs linked to the conflict, but finished steel prices haven't kept pace. That squeeze is forcing producers to scale back output, At the same time, demand remains weak, particularly from the property sector, which continues to struggle. So what you have is a combination of higher costs and soft demand, a difficult environment for any industrial producer. Aluminium, however, is telling a slightly different story. Production in China actually increased, supported by higher prices driven by supply concerns. The Gulf region accounts for a meaningful share of global aluminium output, and any risk to that supply base tends to push prices higher. That said, higher prices are also creating volatility. Domestic demand in China has been uneven, and inventories have climbed to multi-year highs. So while producers are benefiting from stronger prices, the underlying demand picture remains uncertain. Now, shifting into carbon and power, the conversation turns to renewables, and specifically solar. At first glance, you might expect higher oil prices to boost demand for renewable energy, and in financial markets, that's exactly what we've seen, with solar stocks rallying in response to the conflict. But on the ground, the reality is more complicated. Chinese solar manufacturers are dealing with a significant overcapacity problem. Even before the current crisis, global production capacity was already sufficient to meet demand nearly twice over, and that structural imbalance hasn't gone away. While there may be a modest uptick in demand, industry participants are clear it's not enough to fundamentally change the supply-demand dynamic. In fact, some producers are warning that the sector remains under intense pressure, with consolidation likely. So even in a scenario where energy security becomes a bigger priority globally, the benefits for solar manufacturers may be more limited than the market initially expects. Finally, let's touch on dry freight and global trade flows. One of the more interesting developments is Europe's growing interest in Canadian liquefied natural gas. Buyers are exploring the possibility of sourcing LNG from Canada's Pacific coast and shipping it through the Panama Canal. This is not the most efficient route. It's longer, more expensive, and logistically complex. But it reflects a broader shift in strategy, away from dependence on geopolitically sensitive regions and toward more stable suppliers. It's also a long-term play. Projects like Xi Lysim's LNG are still years away from completion. But the fact that European buyers are even considering these options tells you how much the current crisis is reshaping thinking around energy security. And that's really the common thread across all of today's stories. From oil and jet fuel to fertilizers, metals, and LNG, the disruption in one critical choke point is cascading through the entire commodities complex. It's affecting prices, trade flows, production decisions, and long-term investment strategies. This is what systemic risk looks like in commodities markets. It doesn't stay contained. It spreads across sectors, across regions, and across time. And as long as uncertainty around the Strait of Hormuz persists, that ripple effect is likely to continue. If you found this episode valuable, be sure to subscribe, share, and leave a review.